Wow, what an introduction. You don't receive one of those every day. Thank you so much, Mark, and thanks so much to the organizers for having me here. Guys, it's always an honor and a pleasure to be here. So this paper is, once they asked an artist, what's the role of an artist? And they said, well, it's easy. An artist is supposed to disturb the peace. It's a good definition for what a theory should do. Right? This paper is a little bit meant to disturb the peace. In this paper, I'm going to ask two questions that there's the null hypothesis and there is the no-no hypothesis. So the two no-no hypotheses I'm going to ask is a very geeky question, a very nerdy question. Is the present value of aggregate consumption finite? Why would we ever care about that? Wait. And number two, whenever we think of the stock market, is what's being priced in the stock market, what's being rewarded, a reward for aggregate risk? Almost sounds like trick questions in a final exam that you ask in asset pricing, because it would seem the answer to both are duh and duh, not even a yes. I mean, like an obviously yes. And this all, kind of comes back to this thing that we're like so steeped into using this representative age and infinitely rift horizon models, what I like to call like the Highlander models. For those of you who are above 40, I guess, you may remember that movie where the guy lived forever. So like this, inside the logic of this model where there's a Highlander dominating the economy, his own transversality condition will ensure that the present value of consumption is finite. And of course, the only risk that's going to be getting priced is whatever this person's aggregate consumption is, because that's what this person consumes. Now, implicitly, this, sorry, I made a mistake here. I'm still learning the ropes with this thing. The reason why this condition of whether the present value of consumption is finite or not is important for asset pricing is that in all conferences, not since 1991 to today, when this conference got started, but probably all the way back to 1891, anyone who has put a price on the left-hand side of an equation and an infinite present value of dividends on the right-hand side of the equation, without really realizing it, has used this assumption. Okay. Turns out that this assumption that the present value of consumption, or the aggregate endowment if you prefer, is finite, is the key condition you have to assume in order to make sure that an economy cannot have bubbles on its assets. All right. Okay, so now many people associate this condition on the absence of bubbles as being the condition that R is smaller than G. It turns out that the best place to start to see why this condition is true is to start with a deterministic setup. Okay. In a deterministic setup, many of you may have heard that the condition for being able to have bubbles in the economy is that the interest rate is below the growth rate. Intuitively, when you have that condition, you can issue a liability, and it kind of, all you need to know, like get the money, you kind of never have to repay it. You just keep rolling it over. Because the interest rate is smaller than the growth rate, eventually, your debts compared to your income will converge down to zero. So, you can have like your little consumption today and never really have to pay for it. You just keep rolling over the bond. So it's a very well-known intuition. Turns out that in the deterministic economy, you can kind of see very quickly that this condition that R is smaller than G that R is bigger than G, is also the same condition that you need to ensure that if you discounted consumption going forward, consumption growing at the rate G, discounting it at R, this is the condition you need in the Gordon growth formula for this present value to remain finite. Okay. Now, we write representative agent models, okay, a lot in macro. In those models, no matter what you assume about preference, none of that stuff matters. Really, the present value of consumption has to be finite. And that's an implication of something that's known the transversality condition, which basically ensures that if the agent cannot arbitrage himself, the present value of whatever they're going to consume must be finite. Otherwise, their value function would not even have a solution. Okay. And of course, that's, even though the representative agent model is a convenient starting point, is not the end of it all. So there has been a lot of research that has been happening over the years in alternative models where you put a transversality condition not on some fictitious agent who lives forever, but on like subsections of agents who live on finite intervals of time. Those are known as overlapping generations models, so LG models. And in those models, because there is no agent who consumes aggregate consumption, everybody just consumes a consumption over the period that they live in, you can very easily have this phenomenon that R is smaller than G, even in deterministic setups. Okay. And Santos and Woodford have shown in a very well-known paper in this literature that the more general condition, if you are in a stochastic economy, the necessary condition that you need to say, or like let's put this with the sufficient condition you need to be able to exclude bubbles, is that the present value of consumption remains finite. In the paper, I have like a very quick proof of that result. Turns out to be easy to prove, but I don't have the time to go through it. Okay, let's just accept it that this is the key condition that you need. You can see it in a deterministic economy. It holds more generally if the economy is stochastic. Now, people have known about this condition for a long while, okay? And because it would be very uncomfortable for us in asset pricing if this condition was not true. It would open the possibility that prices are not equal to their present value of dividends. We've tried to give like some very high-level arguments to kind of say, yeah, this is a theoretical possibility in the data. We kind of know the present value of consumption must be finite. And I'll give you the high-level arguments in a slide from now. Bear with me. Okay. So a lot of what I'm going to be doing in this paper, I'm going to be criticizing that. I'm going to be saying there is a fallacy in these high-level arguments that we're giving for whether this condition holds or not. And this brings me to the second question, that in order to ascertain whether this condition holds or not, actually it turns out that the information that you need, ideally, would be to be able to look at some contracts that I'm going to call GDP futures or GDP contingent bonds. So really contracts that isolate how the market feels about the risk premium for bearing pure consumption risk or pure GDP risk, if you prefer. Okay. Why would these contracts be useful? Because from these contracts, we could very quickly tell if the expected growth rate of the endowment under the risk-neutral measure, remember when you try to price things, you care about the risk-neutral measure, not the actual measure, whether the expected growth rate under the risk-neutral measure, whether that is bigger or smaller than the interest rate. Okay. Turns out, like in the US, even though many people, and for many good reasons, propose that we start GDP futures, and I'm going to give maybe at the conclusion an argument why that would be potentially a very smart financial engineering idea, it never took off. So I'm going to look at a historical episode where these bonds were actually traded. Okay. Now, I want to say like this is a little bit of independent interest, okay, because it turns out that if you look through asset pricing, what we've been doing for like 40, 50 years, we haven't really been pricing claims to the stock market. We have been pricing GDP contingent bonds. Okay, and I'm going to make also, we're pricing at present value to consumption after all. Right? So it's like a portfolio of GDP contingent bonds. So we're going to look at what are those properties, and in 2 slides I'm going to tell you there's something surprising to be learned from looking at those things. In particular, I'm going to try to convince you that the second question I answered, whether these bonds will turn out to have like relatively low equity premiums, risk premiums, excuse me. Actually, so low risk premiums that it calls into question whether we've been thinking straight about the stock market being compensation for aggregate risk. I'm going to do a decomposition where I'm going to be showing you that if you take the returns on the stock market and you, during that episode, and you hedge out all exposure to aggregate risk, you're still left with a very healthy equity premium. About 60% of the equity premium has nothing to do with aggregate risk. So that's the outline of the talk. Let's go. So the first thing I want to talk about, remember 2 points. One is whether the expected value of the growth rate under Q is bigger than R. Second is whether the stock market really rewards aggregate risk or not. Turns out the two are very closely connected. Here's an argument that people have been giving why the present value of consumption must be finite. They say, look at something like land. Land has payouts that are co-integrated with aggregate consumption. Say we have, like we think of a balanced growth economy. Land kind of has a rental that is co-integrated with consumption. And by a very popular, I would say, misperception in asset pricing, incredibly popular and pervasive, there is this view that if two claims are co-integrated, if they share the same stochastic trend, in the long run, if you look at dividend strips to those claims, if you look at the behavior of they should have similar yields. And the intuition is actually very simple. You say to yourself, take two things that are co-integrated, take two cash flow processes that are co-integrated. In the long run, they're going to look perfectly correlated. What's going to dominate is the stochastic trend. The little ups and downs is not going to matter. So in the long run, you would kind of expect that whatever is the yield of the one is the yield of the other. In particular, if the dividend strips of a traded claim converge to zero, so should the dividend strips of anything that's co-integrated with it. So put two and two together, if consumption is, say, co-integrated with a rental rate of land, or with anything, actually, with any claim that like pays a co-integrated cash flow, if the dividend strips to the one sum to zero at the tail, the dividend strips of the other should sum to zero at the tail. Fallacy. Okay, we're going to together, like I'm going to spend most of the talk today constructing a very specific and like financial engineering motivated example to show you that it is possible to have a claim that kind of blows up at infinity. If you asked your financial engineer, replicate these things, they would tell you all the money in the world could not replicate it. All right. And yet, you can create a very nice, finitely valued, self-financing strategy that produces cash flows that are co-integrated with it. So this high-level argument by which we can say the minute we have land and it's finitely valued, present value of consumption must be finite, true in a deterministic economy, not true in a stochastic economy, and we'll see why. Okay. On the second point, okay, it turns out because I'm going to say if these high-level arguments don't work, we have to do actually the legwork of figuring out how to discount consumption, how to literally discount consumption. And this is where we're going to get into this French experience where just like nowadays in the US we have TIPS, the French back in the 60s introduced literally GDP contingent bonds. Turns out the Sharpe ratio of those bonds was 0.35, 0.39, depending on like the subsample that you look. Very small. Very much in line with what the basic 1970-something Lucas 3 model would tell you. So as a matter of fact, in asset pricing, we spend years and years trying to figure out how to price the stock market when the real, and why our equity premiums are not big enough, when the real question we should have been asking is, what are all these other risks that get rewarded in the stock market that seem to have nothing to do with GDP risk? Okay, and paradoxical from the perspective of representative agent models, where it's only aggregate risk that should be priced, not paradoxical at all from the perspective of markets like OLG, like heterogeneous agents models, where distributional risks are being priced. All right, who gets what matters for whose Euler equation is active. Okay, so here's how I'm going to structure the talk. We're going to spend the next 5 to 10 minutes with a very fun question. All right. I'm going to first try to say why these high-level arguments that the present value of consumption is finite don't work. Okay, and I'm going to motivate it with, suppose you sit at an endowment, and somebody comes to you and says, look, we have this target cash flow C we would like to be paying out. I'm going to join many of the previous presenters and say, this is confusing. Okay. Say I have like this IID growing cash flow that random walk, if you prefer, in logs. That's going to be growing at some rate G. Very quick, very soon I'm going to be making assumptions so that this G is sufficiently high compared to what interest rates are and what investment opportunities are, that if you went to your favorite financial engineer and told them, how much should I pay to have something that exactly pays me this sequence of cash flows, he'd say, I quit. I can do it, R is big, R is smaller than G, I just can't finance this forever. So then they come to you and they say, look, this guy is a stickler. Like, he just can we do something close to that? Which is, can we devise a trading strategy and a payout strategy, all right, so that even though the present value of the sequence of cash flow C is infinite, the cash flow that this fund, this finitely valued fund is going to be paying is going to be co-integrated with C. So you scratch your head and say, well, let's give it a try. And I'm going to convince you there is a construction that works. So let's assume that the way we can invest our funds is precisely the same way that kind of Merton devised his world, there's going to be n assets driven by n Brownian motions. You can make n bigger or smaller, incomplete or complete. That doesn't really matter very much. I'm going to order the first Brownian motion to be the same Brownian motion that hits this cash flow C, but there's going to be a bunch of other Brownian motions here that hit the asset. So there's not only going to be one shock that affects asset prices, there's going to be multiple shocks. How am I going to model the evolution of the value of the fund? I'm going to be saying, again, like this is the standard Merton formula, the fund grows at the rate R. You get a portfolio of excess returns. W is the portfolio that you choose, and mu E is the vector of excess returns. And then over here, that's the payout ratio, which is where all the interesting stuff is going to be happening. How am I going to be paying out of this fund? Right. And of course, here is all the turbulence you introduce into your portfolio by all these Brownian motions that are hitting the asset space. All right. So far, this is, can go back like to the 1970s. This is the model we've been working with forever. All right. So the goal, once again, I have this target cash flow C. Potential is growing incredibly fast. I'll make assumptions to make sure so fast you couldn't replicate, like you couldn't create a replicating security of that with all the money in the world. The question is, can I come up with a strategy X that starts with finite value, W0, and pays a cash flow that's co-integrated with C? Let's commit this notation to memory. This little ZT is going to be the gap between log wealth and log consumption. This is the log wealth to consumption ratio. So consumption is this target cash flow C that I want to be paying out. Think of it as the wages that your professors are paying that are growing faster than the interest rate, so you got yourself a problem. So as a university endowment, you want to do something that keeps the payouts co-integrated with that. I'm going to, I'm here just to show you one construction that works. This is not the only one, but this is the easiest one. All right. I'm going to set this cash payout to wealth ratio to be equal to the max of some affine function of Z and some little epsilon. If you want, this epsilon is like what the tax code puts on nonprofits in the US, that you have to have a minimum payout out of your assets. All right, if you want to motivate it with that. For me, it's going to play a very important role. It's going to make sure that the cash flow checks are always positive, that I always pay out something. Right? They can never turn negative. It's going to come in somewhere in the proof. All right, one more piece of notation. This capital A. This capital A is going to be the difference between the logarithmic growth rate of wealth, if you choose a constant. I'm mostly going to be looking at constant portfolios W, and the logarithmic growth rate of consumption. Basic ethos lemma says, this is the growth rate, the logarithmic growth rate of wealth, subtract the logarithmic growth rate of consumption, and the rest is just these annoying Ito adjustments. Okay, so here's our first result, which you're not going to find very surprising. As long as there exists a portfolio W, think of it, how high can that be? Think of it as the mean variance efficient portfolio. As long as the logarithmic growth rate of the potentially mean variance efficient portfolio exceeds the logarithmic growth rate of this target cash flow C, so as long as my portfolio has a tendency to grow, assuming no payouts, if it has a tendency to grow faster than the logarithmic growth rate of consumption, then this construction that I have had will lead to a wealth to consumption ratio. I'm going to drive you crazy with this pointer, sorry, which is stationary. Okay. So eventually, effectively what I'm doing is with this payout process that I have constructed over here, if the Z, if the wealth compared to the consumption target is high enough, then I pay out a lot, linearly actually. When it falls below a given threshold, I just pay the minimum. I always pay something, but when things are good, I pay more. When things are bad, I pay the minimum. So proposition number one is that this payout strategy will have this remarkable property that the wealth to consumption ratio, the wealth to target consumption ratio, will remain stationary. As a matter of fact, with all this stuff that I have assumed, you can even compute the stationary distribution. I didn't put it here because you can't learn anything. It's just basically an exponential on the one side and a normal on the other. you can even solve exactly what a stationary distribution looks like. The reason why I wanted this particular functional form is precisely because then I can solve the Kolmogorov equations. I can give exact characterizations of everything. All right. So here's an illustration of this first proposition. If you start out with a situation where, let's think of this red line as being the growth rate of the fund, all right. If this logarithmic growth rate of the fund is bigger, assuming no payouts, is bigger than the logarithmic growth rate of consumption, then you're going to get this picture when you follow my payout strategy. You would if I was able to figure out which way is forward and which way is back with this thing. So once you start paying out, then the log wealth growth rate and the target cash flow will look co-integrated. Okay. As a matter of fact, because the way I specified this payout strategy is just a function of z, okay, the cash flows to the consumption rate will be co-integrated as well. Okay. So here's then another proposition, okay, which says, I'm going to get to it in a second. This is where I'm going to. I'm going to try to show to you that even though these cash flows C and XT are co-integrated, if I look at dividend strips to these cash flows, if I go, at some big cap T, I price a dividend strip to C, I price a dividend strip to X, and I compute the yields of those dividend strips. All right. As a matter of fact, let's make it even more interesting. If I look at the value of a dividend strip to C and a dividend strip to X for a long enough horizon, I'm going to show you that the dividend strip to C blows out to infinity. The dividend strip to X goes down to 0. The two cash flows that are co-integrated, dramatically different behavior of the long-term dividend strips. Well, how does that work exactly? Okay. So let's go ahead and price those strips. As is well known, and I don't want to deal with incomplete markets and have the fight of how do we price things in incomplete markets. I'm just going to assume a complete market. In a complete market, standard textbook stuff, there exists a unique stochastic discount factor, and as a matter of fact, the Sharpe ratios are just given by the returns to the mean variance efficient portfolio, which is exactly over here. Okay, so this kappa, this vector kappa, this is the return of the mean variance efficient portfolio. Okay. All right. So with all of this, let's go ahead and define what these dividend strips are. Well, take the stochastic discount factor and price X out to infinity, normalized by the current value of X. That obviously doesn't matter for the asymptotic. That's just whatever initial constant there is. And similarly, you can do this for the target consumption rate. Now, for the target consumption rate, that you can do like that, because it's an IID growth rate just discounted at R. Basically, the yield's going to be constant, so the term structure of dividend yield is going to be constant. And what I want you to pay particular attention to, not too surprisingly, you're discounting at R minus G, plus this little risk adjustment, which is what? You're taking the first component of the Sharpe ratio, so whatever price of risk there is just for the Brownian motion that hits C, and you're discounting with that. All right. So I'm going to make assumptions that this creature over here is negative, meaning as time goes by, the present value of this dividend strip blows out to infinity. All right? So that's what your financial engineer says, I quit, I cannot price this thing. How about this cash flow? All right, how about the dividend strips to this cash flow? For this one, you don't even need to do a lot of thinking. You know that the dividend strips of that creature are going to go down to 0. How do you know that? Because you start with initial financial wealth that's finite. All right, just take the definition of any return, iterate it forward. It says that the present value is equal to the present value of these dividend strips plus whatever is the present value of wealth that remains. That's positive. So the current present value, the current price of the fund, the initial value of the fund, is an upper bound to the value of all dividend strips going forward. These dividend strips are positive. By monotone and dominated convergence, you know that this tail has to go to 0. You don't need to do high-level proofs. You know that these dividend strips have to go to 0 because you start that trading strategy with finite wealth. Okay. So here's the second proposition. there exists an open set of parameters with two properties. This creature over here, R minus G plus the risk adjustment, is negative, and yet, all right, it is still possible that A of W, the logarithmic growth rate of the fund under P, under the natural measure, minus the logarithmic growth rate of consumption, which is what matters for the ability to create a co-integrated cash flow, is positive. So in other words, it's always possible to find a payout strategy. Okay, it's always possible to find a payout strategy. It's all to find an open set of parameters so that you simultaneously can have like a sequence of dividend strips for X that goes to 0 and get the dividend strips for C, which is co-integrated with X, blow off to infinity. What's the intuition behind this? How can it be possible that you have two co-integrated claims and their dividend strips look diametrically different? Okay. Long story short, it all has to do with the fact that co-integration under P does not imply co-integration under Q. All right. So let's work through this for a second. Let's define F to be the ratio of X to C, create yields, like price what yields are, do a little algebra here to express the yields, to relate the yield on X, to relate the yield on X to the yield on C. And what you find is that what's left over is some expectation under Q of this ratio X over C. This expectation is under Q. It's not under the natural measure. Okay. So what is intuitively happening here? Why can you create these examples where like under P things diverge, under P things create co-integrated cash flows between X and Z, and under Q they don't? In the interest of time, let me just like give it to you verbally. Under P, things carry risk premiums. So by choosing a portfolio that loads on risk premiums other than C, other than like the risk premium that loads on consumption, you can make sure that your fund under P grows nicely above the growth rate of consumption, which is key for creating this co-integrated cash flow. Under Q, the defining property of Q is there are no risk premiums on the assets. The only risk premium that matters is that one risk premium associated with consumption. Okay. So as long as you create a portfolio that loads on these other risk premiums, so that you get rewarded, you create a high growth rate for your portfolio out of risk premiums other than what gets rewarded in consumption, you can always, I mean, not always, but as long as the Sharpe ratio on the mean variance efficient portfolio is high enough, you can always find examples where you can create things that are co-integrated under P, but not under Q. Under Q, it seems that your wealth is not growing fast enough in order to catch up with consumption. What did we learn from this example? By the way, this is like a very problematic thing. Whenever you have, turns out, dividend strips of two co-integrated cash flow processes, at any horizon, you cannot get like any information from one strip for the other. So here's an example where the dividend strips to consumption are just flat. This is the difference between the two consumption strips. Consumption strips to X look downward sloping. They seem to have a lot of life to them, even though here, Sharpe ratios are constant. Everything is IID. The consumption stream has like a constant term structure, but X is going to look like it has downward sloping dividends that don't converge to the ones for C. In the final, what this lesson is supposed to tell us is that you can make that high-level argument that says if there is things that have like a rental rate that's co-integrated with consumption, the finiteness of these claims imply the finiteness of the consumption claim. It would be true in a deterministic world, not true in a stochastic world, because co-integration under P does not imply co-integration under Q in entirely non-pathological examples. So what can be done? How can we like just get a little bit of traction? And this is the part where I made a little bit of selfish choice, because this is where the paper really goes completely empirical and looks at that episode in the French experience where the French introduced these growth contingent securities so that when we have these securities, where we have cash flows that are proportional to GDP, we can actually do what we can do with TIPS. Just like with TIPS, we can measure break-even inflation, the expectation of the inflation rate under Q. We can do the same thing to compute the expectation of growth rate under the expectation of the growth rate under Q, the break-even growth rate, if you want. I'm completely out of time, so let me just show you one graph and conclude. Okay, Mark, give me just 1 minute, all right? Let me conclude with this. I went ahead, looked at all the contractual specifications of these things. Like, trust me, like there's a lot that you need to do because the data is not great, so you have to like really work hard to get something out of it. I think I did, okay, just trust me. All right, I did whatever can be done with this data. The most important thing is you have just a single issue, but you have these things trade very frequently, so you can get prices as they come close to maturity. So that was like the main challenge. All right, but like I did whatever can be done with this data. Long story short, if you actually go in that episode and see what is the break-even growth rates for the French growth rate that is implied by those bonds, during that period, what did I do? No, what did I do? I promise I didn't press the wrong button. You told me not to press a given button, I didn't. The break-even growth rate is about 2.6%. That's during a period where the French growth rate was about 4% with a relatively high volatility, okay, around 4. You do the calculations, you get a Sharpe ratio around 0.39 for this risk. Now, if you believe that, if you say that this is the compensation that you have for this growth rate, you can do a very simple exercise, and I'll conclude with this, go all the way back to the very first slide, which is how much of the equity premium of the stock market is due to aggregate risk. So let's throw in that number 0.39, look at what is the correlation between stock market and the growth rate, multiply with the volatility of the stock market. This is basically what you would get, the equity premium you would lose if you were able to invest in GDP futures to wash out all the aggregate risk in the stock market. So just like have something that's uncorrelated with GDP risk. The residual of what would remain would still give you an equity premium of 3.5%. So there's stuff happening in the stock market that has nothing to do with aggregate risk. And with that, I'm going to conclude. I think I wanted to challenge two things, all right, of the standard model. First of all, this assumption that we're making without thinking about it, which is present value of consumption is finite, there are no bubbles, present prices are equal. These high-level arguments that you find in the literature, which is, well, you have co-integrated things, it doesn't matter. If they're finite, it doesn't work. That's a fallacy. Co-integrated things, their dividend strips or the behavior of their tails could be completely different. Second point is, second tenet of these models, which is that the only risk is aggregate risk. That also does not seem to be true. GDP hedged equity returns would still have an equity premium, a sizable equity premium. Thank you.